Okay, well, good morning, everyone, and welcome. Thank you very much for joining our webinar. My name is Aidan Smith. I'm one of the audit partners here at Mann, Judd, and I will be your host this morning. So today we're presenting financial reporting and a tax update presented by a panel of experts. You see there, we've got Joel there, and Michelle Warren and Carmen Ridley. All right, so on to our first presenter. I'd like to introduce you to Joel Dare, and he's one of the tax consulting partners here at Mann, Judd, and Joel's going to provide you with the tax update. So it says here that Joel's a highly qualified and seasoned taxation practitioner, and through ongoing presentation to members of the Tax Institute and the CAANZ, Joel's become recognised as an industry thought leader, and due to his understanding of commercial tax matters, particularly those that apply to small to medium-sized businesses, and that includes expertise in tax consolidation, including in relation to corporations treat losses, depreciation deductions, cost bases, franking credits, intercompany transactions, and really looking at how the tax consolidation regime can help corporations restructure their affairs and pursue growth while maximising tax efficiencies. Transactions advisory services, that's taxation due diligence, thorough analysis of historical tax returns, financial statements to look at the risks and opportunities, and international tax as well. And that includes transfer pricing, foreign source income, permanent established matters, and all matters like that. So that's what it says here, and I agree with all of that, 100% agree. So without any further ado, I would now like to hand over to Joel.
Appreciate it, Aidan. Look, as you might appreciate today, I'm a bit of a taxi warm-up act for our main session presenters, Michelle and Carmen, but thank you very much for that extensive introduction. It might actually take a little bit longer to introduce me than I've got to say to you all this morning, but thank you anyway. So I might just move over now to the next slide. So the things I really wanted to run through with you are exciting and topical aspects that come out of recent budget announcements, most affecting those in the corporate and financial reporting areas. And so I was originally going to run through some of the Jobkeeper aspects, which is a product we've had in mind for some time, but I thought probably more relevant for this presentation was to really give a full deep dive into these two new key measures, which are most likely to have significant cash flow impacts, positive cash flow impacts for corporates in particular. So the two areas I really wanted to focus on today is something that's really popped up in the last month, is temporary full expensing of depreciable assets. And then I'm going to move on to the loss carryback regime. Now, both of those have the capacity to really significantly enhance corporates' cash flows in what's a relatively difficult environment for many finance functions at the moment. So I thought that was why we should have a bit of a focus on these before moving on to our financial reporting update presenters. So the first one I wanted to touch off on was temporary full expensing of depreciable assets. I suppose what we can see there is a bit of a context. Previously, a lot of us would have got used to this idea of the instant asset write-offs, and they've been growing incrementally, and they're quite hard to keep track of in a practical sense to understand how the rules have changed and evolved, and essentially they become a great deal more concessional with this newly introduced measure. What is it in essence? Okay, for depreciable assets acquired after the budget night and before 2022, there is an availability of an instant depreciation amount for the full cost of purchasing an asset, which of course is very attractive for those businesses who are considering income tax liabilities, and hopefully that's a number of attendees today. Now, I just thought I'd run through some of the key criteria that you have to meet to get an immediate tax deduction for buying a depreciating asset. It has to be for an asset which is used within a business in Australia. It has to be acquired and installed ready for use between budget night 2020 and 30 June 2022. An improvement, I suppose, from having a look at the previous version is that these provisions for a full expensing of depreciable assets are actually available for corporate groups with an aggregated turnover up to $5 billion. And so that, while that's not the very large taxpayers segment, a lot of taxpayers will now be in a position where they could really look at these measures and possibly get into the instant depreciation regime for a much wider array of businesses than would have been the case previously. But in addition to being available up to $5 billion of turnover, there are also some additional eligibility criteria that relate to base rate entities or entities with an aggregated turnover under $50 million. So they can get the full expensing of depreciable assets up until June 2022, But in addition to that, they're also potentially eligible to get full expensing of an acquired depreciable asset for a second-hand asset. And the other thing that's concessional for that less than $50 million base rate entity type market is that it's also possible to claim a temporary full expensing of depreciable assets, even if you've entered into an arrangement to buy the asset before budget night. Now, that's not available if you're over $50 million. It still has to be installed ready for use after budget night and before June 2022, but it has a wider eligibility if you're in that base rate entity regime. And now I might move to the next slide. So just to give a little bit of a compare and contrast, because there has been such a lot of movement in the extent of concessions available for purchasing depreciable assets, just a quick recap of those provisions as we knew them to be before the budget night, or the context that was there. You would have been aware in some cases that the instant asset write-off also is a product within this market, but significantly less availability for taxpayers to apply. So it applied only for assets acquired up to $150,000, and it was eligible or available only to entities with an aggregated turnover of $500 million. So the temporary full expensing regime allows you to have a turnover 10 times as great and still qualify. Also, that the time frame over which the instant asset write-off was available was in full up until December this year, and a half write-off from January to June 2021. So we can see that with the full expensing of depreciable assets, the size of taxpayer, the type of assets you can buy, and the period over which you can claim it has increased very substantially. Now, the instant asset write-off is, of course, still available if you don't qualify for full expensing, and that would be to cover a case, for example, where you've actually installed that asset ready for use before budget night 2020. So that was just in the last month. I'll move to the next slide. So look, just a couple of really sharp issues that we see emerging through the expensing of depreciable assets. We've seen over a period of time that tax and financial reporting needs treat assets that are held under a periodic arrangement very differently. So a lot of what we see is what sometimes gets referred to as right of use assets. And the confusing aspect about that is, although you have a right of use asset for financial reporting purposes, that does not mean that you become the holder of a depreciating asset for tax depreciation purposes. So that's going to create a really important cutoff and distinction that finance functions need to be aware of. If you have some kind of a periodic, for example, an operating lease arrangement, which is treated as a right of use asset for financial reporting purposes, that does not mean you are the holder of the asset. And that's really important, because if you anticipate getting a full instant expensing of depreciable assets, you need to be the holder of the asset for tax purposes, and that's not influenced in any way by the disclosures that you have as a right of use asset or otherwise. So the things to watch out for there is you have to be the holder of the asset for tax purposes to get into full expensing. And that will mean, generally speaking, that it's likely that you'll become the economic owner in an ultimate sense. So what we might have referred to traditionally as operating leases, where it's likely you'll hand back that asset, those assets will not be ones that will typically qualify for expensing of depreciable assets, or similarly for finance leases that aren't, for example, luxury car leases. It's also extremely important that for understanding what assets qualify for full expensing, that you work out very clearly the distinction between what is a depreciable asset and what's a structural improvement. Now, a structural improvement is typically thought of as being the setting or the passive background to the income producing process. And so those things that form part of your structure are not depreciating assets. And the distinction there is that if they're not depreciating assets, they can't qualify for full expensing immediately. You'll typically get them over a period of 40 years instead. And of course, the financial difference between that and getting the full expensing treatment is very significant. So those are sort of key aspects to understand before you enter into any of these arrangements with an expectation of getting a full expensing outcome. And another thing that is sort of front of mind for an awful lot of finance functions is that the full expensing and instant deductions can be very attractive, but only to the extent, of course, that you're actually anticipating paying any income tax in the short to medium term. I suppose that's a good way for me to segue into the next part of my presentation on the next slide, which is the corporate loss carryback. And so this, I suppose, is a bit of a hand-in-hand measure which assists things such as the instant asset expensing regime. And what it allows corporates to do is in a situation where you've had previous payment of profits, but in the current operating environment are dropping back into a tax loss scenario, which could be either, literally an economic loss is being incurred, or it could be, for example, as a result of taking up a lot of additional deductions under the instant expensing regime. So corporates will then have, as a result of this measure, the ability to take a loss that they've incurred in a later year and apply it back to profits made in an earlier year. So that's the reverse of the usual situation. So in those circumstances where you have a loss in a later year, a refundable tax offset will become available, and it will effectively act to recoup some of the tax that's been paid in earlier years. So it's important to understand here what the scope of operation of the potential corporate loss carryback is. So it will apply, or potentially apply, in a situation where you've got a tax loss in FY 2020 or 2021 or 22. So that is as a temporary loss carryback measure. It's not in place in an overall eternity. And it will apply in a circumstance where a taxpayer has had tax to pay in an income year no earlier than 19. So if, for example, you make a tax profit in either the 19, 20 or 21 years, if you then make a loss in the 22 year, in the 22 year, you would become eligible to elect to take a refundable tax offset for that year. Or equally, for a lot of taxpayers currently, they might have had quite a profitable 19 year and are finding that in FY20, they're in a situation where they've dropped into tax loss. And so that's a situation where, in relation to that 2020 year, they would be able to claim a refundable tax offset. And how much is that refundable tax offset? Well, it is in essence capped out as the amount of tax that you paid in the early year. But an important thing to note is that the amount of refundable tax offset you can claim is determined by your tax rate in the year in which you incur the loss. So, for example, if you're one of those base rate entities that is currently with turnovers under $50 million, you might have seen your corporate tax rate drop from year to year. When you go and claim your refundable tax offset, the amount that you can claim is determined by your tax rate in the year in which you make the loss, but it's also capped out at the amount of tax that occurred in the earlier year. So there can be some situations in which you are a base rate entity for an early year and you pay tax at, for example, a 27.5% rate. But if you've grown significantly in the intervening period and now 30% taxpayer, you do get the 30% rate, but it's capped out at the amount of tax that you've paid in the early year. And so why I think that's particularly useful is especially for finance functions that are very carefully managing their cash flows at the moment, that the corporate loss carryback will mean that the time at which you can actually get the cash flow impact or benefit from tax losses is brought forward very significantly. So if you're in a situation where a business is dropping into a temporary period of loss and you have to forecast out the time at which the cash flows are going to become available from the use of that loss, the fact that it can be brought forward into the 20, 21 or 22 year may be very significant in terms of your cash flow forecasting. Might move over to the next slide. Now, just a couple of limitations to be aware of in the loss carrybacks. So again, similar to what we saw with the instant asset expensing model, it's got a $5 billion aggregated turnover maximum. So it's dealing basically with the same corporate market. So it's quite Treasury have said it's 99% of taxpayers. Well, that's probably true in a numerical sense, but of course the larger businesses probably contribute greater losses within the economy. It only applies to corporate structures, something taxed as a company. So it's all taxed as company situations, but also public trading trusts and corporate limited partnerships. One thing to be aware of there is that the amount that you can claim as a refundable tax offset under the loss carryback is actually constrained by your franking balance at the end of the year in which the loss is incurred. So it's not the time at which you lodge the tax return which claims the loss carryback. It's actually at the end of the loss year. And so that's one thing to watch out for, is that this will not be available if, for example, you've pushed out all those profits as franked dividends, but in the original profit year, and there's no franking balance against which to apply. That claiming a refundable tax offset will actually give you a debit to your franking account. One curious thing about this new regime is that although you can claim a refundable tax offset from the 2020 year onwards, it's not actually possible to claim the refundable tax offset until you lodge your 2021 return, which is a bit of a counterintuitive type of cash flow boost, because it's one we actually have to wait quite a long time for it to hit. So that's one thing to keep in mind. And also that to the extent that cash flow is really important, that you might want to move forwards and quickly with getting your 2021 tax return prepared and ready to lodge. Another curious one here is that you must have lodged a tax return for the preceding 5 years. Or alternatively, if you actually weren't required to lodge, you can also become eligible. But it will mean then that it's very important that if you want to claim the refundable tax offset for a loss carryback arrangement, you need to make sure that you have all of your lodgement history up to date. You can't get a loss carryback for capital losses, which is an important one to keep in mind, just in case that's the source of your losses for the later year. And another thing to keep in mind is that if you're moving into tax consolidation, the corporate tax paid by a subsidiary of a tax consolidated group can't qualify. So if you've got, for example, you were outside a tax consolidated group, you paid profits, and then you moved into the group and the group made a loss, you can't carry back and claim a refundable tax offset against corporate profits that were actually made by a joining subsidiary. And I think I might move on to the next slide. Now, just a few integrity measures to be aware of in this regime. The tax office, or sorry, Treasury, I should say, have identified a number of scenarios where they're a bit worried that the loss carryback regime may be abused. Now, my intuitive feeling would be, does that suggest that people actually go out and buy a business or a shell of a business with the intention of making a loss? Well, apparently they do. So the concern there is that in claiming the refundable tax offset for an early year loss, the tax office will have a look at the integrity of situations where, for example, a corporate entity has a history of paying tax and making profits, and then goes through either a change of ownership and or change of underlying assets. And then a new business or a new series of assets are birthed within that existing entity, which has a startup period or an expectation that some kind of loss will be incurred. And what can apply in these kind of situations, if you do have that situation of, I guess, a corporate rebirthing, the tax office can actually deny the capability to use a corporate loss carryback to get a refundable tax offset. And the key aspects to watch out for there are, have you got a change in the underlying ownership? Have you got a significant change in the underlying business assets that the entity has and have given rise to original profits versus those that ultimately give rise to a loss? And that was the end of my presentation. And just a reminder, everyone, that we'll have a Q&A session. You'll see the Q&A at the bottom of your box today. We welcome your feedback, and I'll pass it over back now to Carmen and Michelle.
Thank you, Joel. Just for pass on to Carmen and Michelle. Thank you, Joel, for that. Making very complex areas sound very simple. So you definitely have my vote as a tax expert, and that's a vote in person, not a postal vote too, I'd like to stress. All right, now to introduce you to our next two presenters, Carmen Ridley and Michelle Warren. So Carmen's a member of the GAAP Consulting Network and principal of Australian Financial Reporting Solutions. So Carmen's a team leader in corporate reporting at GAAP, and Carmen specialises in financial reporting advice, accounting standard interpretations, technical training, and financial statement reviews. Carmen, through experience, has an excellent knowledge of financial reporting, and that's experience with her training. And then prior, she worked in the external audit and technical divisions in a number of firms and assisted clients as well with their accounting standards interpretations. So Carmen's clients include private, public sector clients, for-profits, not-for-profits, and many listed entities as well. I'd also like to introduce Michelle. Michelle is our Director Financial Reporting, HLB Mann Judd. Michelle provides leadership on financial reporting matters across the HLB Mann Judd Australasian network. So that includes overseeing our thought leadership process on financial reporting issues, developing and delivering technical training content to our clients and also to our staff, providing technical accounting advice on particular clients, and overseeing the financial reporting quality control monitoring process. Michelle had many years experience in South Africa, which is the Audit Associate Director. She had a large client portfolio, small to large private owned companies, listed companies as well, subsidiaries of overseas entities, all of them. And then Michelle came over to Australia in 2015, and we're lucky enough to have her here as here at HLB Mann Judd. So now I'll pass it over to Carmen, who will start her presentation.
Excellent. Thank you, Aidan, and welcome everyone. Just the normal disclaimer, obviously what we're saying is just generic rather than specific training advice. So I guess for those of you who've been to these sessions a number of times, doing it a little bit different today. I'm not talking to you about leases and revenue. I'm not talking to you about major new standards. We're doing a bit of a high level overview on what's been happening, giving you some lessons about what we've seen, having a look at particularly what ASIC have been doing in regards to corporate reporting and restatements. So we'll start with ASIC. Unfortunately, ASIC seem to be getting a bit later and later with their focus areas. They didn't, in fact, release their June focus areas until July. So I'm not sure when we're going to get the December ones, but we are not expecting a huge amount of difference in the December ones compared to the June ones. Those of you who have looked at these focus areas regularly, and ASIC do release them every 6 months, we'll probably look at them and think there is not a lot of change, and there really hasn't been a lot of change in them for a number of years. From my perspective, it makes it a little bit boring because I have to keep telling you about the same things. However, it's also a little bit sad because we're still seeing the same areas that entities are struggling in. And when we move on to look at the restatements, a lot of them are really focused from these. So I'm just going to talk briefly on each of them. They've almost split up one of them into emphasizing it so much they've kind of almost, I think, repeated the same one twice, so number 1 and number 2. So what they've said in number 1 is, given the current environment that we're operating in, there will be a number of factors that do affect asset values, and by asset values they mean impairment. Provisions, assessments of going concerns, assessment of solvency. At June, we talked a lot about what was happening with COVID. I know that a number of you are in Sydney, but I'm sure that there is a number of you interstate as well. Michelle and I are both from Melbourne, and we've had a very different last 3 months than pretty much everyone else in the country, in the different states. So if you've got different operations in different areas, you might find that some of them have been going great guns, some of them quite possibly haven't. So their first point is think about the factors that could affect your operating. The second point, point number 2, is asset values. Think about impairment. So that's why I mean it's a little bit repetitive, these two. One of them is focused on the factors. The other one is their normal asset values, their normal impairment that they keep in every single year. They've given us a number of assets that they are going to be focusing on. I am hearing a fair bit that they are challenging entities about their right of use asset. Joel talked about the right of use asset being different from accounting and tax. For accounting purposes, we do have an asset that sits on the balance sheet, and ASIC want to know that you've changed your impairment model to consider the fact that you have an additional asset in play. So they've talked to us about PP&E, the intangibles. Don't forget we've got the expected credit loss model for our receivables, so we have to effectively guess what we think that loss is going to be. And that's quite possibly different from when we set up the model a couple of years ago for under the new financial instruments standard. Deferred tax is something that you might have thought you were doing really well, and you might have recognized your deferred tax assets because it was probable you were going to use it. 2020 has not been a good year for you, and therefore it may no longer be probable that you are going to utilize that deferred tax asset. Just because it was okay last year doesn't necessarily mean it's okay this year. So make sure that you've got that documentation about whether that deferred tax asset is still probable. They've added in provisions, kind of comes and goes, this one. And I guess this again is from the current environment that we're in. So a number of contracts that people might be seeing have now become onerous, particularly around some leasing arrangements where you might have been subleasing it, you might be renting it, nobody's using it. Certainly in Melbourne, there's a lot of very, very empty properties where the contracts have become onerous because there's no benefit come from them. If you have provided financial guarantees to any of your related entities, you probably previously did not book them because of course it was never going to be called on. What about now? Is it now probable that those financial guarantees may be called on? And do you need to recognise a provision for those? Any restructuring that you've had to do, provisions that arise from those. Kicking over to subsequent events, what has happened since the year end? So remember that this was the June focus areas, And obviously in Melbourne, it all went crazy in July. So particularly this subsequent event comment that ASIC made was very much targeted at Victoria in Melbourne. Who knows what is going to happen at December? I'd like to live in my little dream world. I've moved my yoga retreat to January in Sydney. I'm hoping the borders open and I actually get to travel to Sydney in January, but who knows? Hopefully we won't have the huge subsequent events issues at December, but something just to keep an eye on. Disclosures. It has been a really interesting period at June for disclosures. I talk a lot about boilerplate disclosures and how we generally see copying from model accounts. Entities haven't really been able to do that at this reporting period. It's been very entity specific. What's been the impact for you? And we have seen some fantastic disclosures, some real open, this is what's going on, this is what we've had to do, this is what we've had to change. That information has given such a great insight into a lot of entities. I would love to think that that will continue. I'm not potentially thinking it will, because I think that it's been a real challenge for entities to be as open as they have. ASIC have told us, please remember your estimates, your judgments, what support have you received? If you're giving non-IFRS information, stop trying to talk about what the results would have looked like if COVID hadn't existed, because you don't know what it would have looked like if COVID hadn't existed. So make sure your disclosures are actually really, really telling the story this time. Then they've put a really interesting one in. So they've called this one reporting processes. And I think what they're trying to get at here is to say, it's all very well putting it in the financial statements that you've made this particular estimate, but where's your documentation to support that? What's gone on behind the scenes? Have you actually gone through a process and management have agreed, yes, this is where we're going to be. This is the assumptions we've made. We're assuming we're going to open on this date. We'll assume our capacity is going to be 60% on this date, 80% on this date. Has that been approved by the board? And why did you come up with all of those? And can I look at a piece of paper that actually shows me that thought process you've gone through? So to me, this one is a bit more behind the scenes. What have you actually done to support the numbers in your financial statements? ASIC very famously said a number of years ago now, if it's not documented, it's not done. And I think possibly that's what they're coming back to. That was in the audit context, but from a financial reporting concept from the preparers, what have you got behind the scenes to support the numbers in your financial statements? And then they've thrown the other in there. Don't forget hedge effectiveness. If any of you do hedge accounting, it may be that they are not as effective as you thought they were going to be when you took them out. You may be getting a lot more returns. Remember, under AASB 15, you have to account for the consideration you expect to receive. And if you expect to get things returned to you, then you cannot recognise that revenue. And what off-balance sheet exposures have you got? We have found that there's been a switch in control of a number of entities as things have possibly gone into receivership or liquidation, and you've lost control. Have you still got exposures to those type of entities? So that's the ASIC June focus areas. As I say, not expecting them to be hugely different for December, but I think there's some really good messages in there. Then they've very recently released their review of the 31 December 2019 financial report. So they're always a little bit behind because they have to wait for them to be lodged and then do their review on them and then go back. We obviously have less December year ends in Australia than June. So there's always less that are reviewed. So ASIC reviewed 90 financial statements. And what they do is they look at them cold. They do a full review, word from word review of them. Anything that doesn't make sense, anything that's not clear, anything that looks unusual, they go back and they challenge the entities. So of the 90 that were reviewed, 21 of those entities got a letter from ASIC. 40 different matters that were covered off in there. So you can see in the table where the inquiries sat. Revenue recognition is not a surprise to me. As those of you who've heard me talk on this before, I've said that the new revenue standard was one of the hardest standards we've had to implement. So it doesn't surprise me at all that revenue is up there and has beaten impairment, I think, for the first time in a number of years. I'm going to give you some lessons from some of these on the next slide. But interestingly, they did say from February to July 2020, based on what was adjusted from ASIC restatements, that was an $80 million drop in profits for entities. They're still seeing round about 4% of entities that they review they believe have a material misstatement. That's still a fairly substantial number that we've got. So let's move on for some of the lessons that I can pull out from this for you. In regards to revenue, is the revenue accounting policy generic? Have you copied it from a set of model accounts? Can I read your accounting policy and say what you actually do, what type of transactions you've got, what type of contracts you've got, and really understand your policy? If the answer is no, you need to look at it again. We used to have the accounting policies in the financial statements that pretty much said revenue is recognized when risks and rewards are transferred. If all you did when the revenue standard came in was to change that to revenue is recognized when control is transferred, it's not good enough. It won't meet the disclosure requirements in AASB 15. So I would encourage you to just take a read of your financial statements and say, what do we say about revenue accounting policy? It should be a good number of paragraphs long. So have a look, make sure that it explains it, because that's one of the red flags to ASIC. If they can't tell what you do, if they can't tell the details of your contracts, they will question you on it. In regards to impairment, you've made assumptions about impairment. Are they supportable? Are they up to date? Or have we just used exactly the same figures that we use every single year? We're not in the same year that we were previously. We're not in the same scenario. We're not in the same economic climate. We're not in the same conditions. Therefore, it's not reasonable to use the same assumptions that we've got. Look at our impairment disclosures. Again, are they boilerplate or are they specific? Can I tell why you've chosen the growth rate you have when we've got goodwill impairment testing? Can I tell why you have chosen the discount rate that you have? If I can't see that moving, it's another red flag for ASIC to come back and challenge you. There was a few inquiries from ASIC in regard to tax accounting. I talked about one of them in relation to the deferred tax asset and whether that was supportable. The other comment that they made was they believed entities do not necessarily understand how the tax expense was derived. The way that I read that is that the tax advisors of the company or the entity give them the numbers and they say, thank you very much, and they plug that into the financial statements. Has anyone actually challenged and gone, hold on, can we just 10 minutes, can you explain why this has arisen? What does this actually mean? Because they're seeing that entities are just plugging the numbers in and possibly mistakes have been made, not necessarily due to the tax advisor's fault. It's just that there was some information that hasn't transferred properly and therefore a lack of understanding of the conditions they were in. Provisions. We're not talking necessarily all of the employee provisions at the moment. I'm going to focus on them in a minute. I'm coming back to the other provisions. When did you last look at how appropriate they were? So if you've got a make good provision or provision for rehabilitation, do you just every year go, yep, that looks about right? Or do you actually look at it and say, what's this provision for? Is it still appropriate? When we introduced the leasing standard, the number of provisions has increased for make good. Now that's not a new requirement. The leasing standard did not introduce a make good provision for leases. It's always been there. However, it hasn't necessarily been applied correctly. So I would encourage you again to look at your non-employee benefit provisions and say, what are they for? Are they reasonable? And are they complete? Is there anything else that we need to be putting a provision in for? Warranties. What's the basis behind our warranties? And has anything changed in the last 12 months? Have we changed supplier? Have we found that things are getting better? Have we found things are getting worse? Have we switched to an arrangement where it's a pass-through warranty and therefore quite possibly our warranty provision has dropped? In regard to employee benefits, the pattern of employee benefits has probably not been the same over the last 12 months as previously because people haven't been taking leave. They've had nowhere to go. So therefore, you might find that your provisions have increased quite significantly. Alternatively, you might have been asking people to take leave to try and actually get some of those expenses down, those costs down. So have a look at the employee benefit provisions and don't assume they're the same as normally. Financial instruments. Financial instruments is the hardest part in our standards. Whenever I get a financial instruments question, my heart drops. It is not easy at all. And ASIC have come back and said, people don't understand their financial instrument transactions. And we're starting to see some even more weird and wonderful ones that are coming through because people have had to come up with more innovative ways to try and inject some cash into their business. If you have done that, great, but please make sure you know what the accounting is. People focus on tax. So if I say to somebody, what's the implication of this that you've just taken out? They will tell me the tax implication because they've done a huge amount of work to figure out that it's a tax effective solution for them. If I ask them what's the accounting, well, I don't know, we'll figure that out near the time. Unfortunately, it's not that simple, and sometimes the accounting outcome is not necessarily what people want. So if you are going to undertake any new financial instrument transactions that are not the plain vanilla transactions, please make sure that you've incorporated accounting treatment as well as all the other treatments. And also, if you are holding any of the financial instruments at fair value, do you know how they were valued? Does it make sense? Is it appropriate? Consolidation and significant influence. There has been a number of queries this year from ASIC where they have challenged entities on their accounting treatment for investments that they hold. So for example, why are you treating it at fair value through P&L when prima facie it looks like it's an associate? You should be doing equity accounting. Why are you treating it like equity accounting when prima facie it looks like you control this particular entity? Back when the new standards came in 2013, so we got a new consolidation standard, we got a new joint arrangement standard, people did a lot of work to look and say, okay, these are the investments we've got, what's our relationship? And then we forgot about it. Look at it again, make sure that whatever, excuse me, arrangement that you've got in place, you understand it, you know the relationship, and you are accounting for it appropriately. I said I wasn't going to talk about leases. I do have a few comments in there about leases. In regard to the new standard, have you explained the choices that you have made? You have a significant number of choices under the leasing standard. Have you disclosed what you've done and have you applied it consistently? So if you've decided, for example, that you are going to exclude non-lease components from your lease liability, have you done that consistently for every asset in that asset class? And have you told me that that's what you've done? So again, just the opportunity to look at your disclosures, look at your accounting and make sure that makes sense. Those are all driven from ASIC's queries that have come back. Now, obviously, their queries are quite specific in a number of areas. These are the generic lessons that I pulled from that. So we've seen that they've made their inquiries. I've given you some of the lessons. Now let's have a look at some of the restatements that have happened. I've put the media release references on here if you want to have a look and get some more information. I'm not going to talk through the details. I'm just going to talk about the particular accounting issue. This is in regard of contingent consideration. So contingent consideration is where something has to happen before you pay an extra amount. So again, it's an estimate. Tell me how you came up with the figure that you thought you were going to pay. In this particular scenario, they've ended up de-recognizing goodwill. So they've reversed their treatment of contingent consideration because quite possibly we'd made incorrect assumptions. So it comes back to that supporting documentation on the assumptions that you've made. Why did you believe that this contingent consideration was appropriate or not? ASIC got excited on one day and released a media release that had 4 different restatements. So that's why we just got one media release for the 4. The first one is in relation to AASB 15. Now, I have to admit, I don't really understand this particular entry. What this entity seems to have done is they've got a multi-year subscription service. So I've signed you up for 3 years, haven't obviously performed the service for the 3 years. And what they seem to have recognized is a contract asset and then a deferred revenue balance in the balance sheet. So we've got a debit as an asset and a credit as a liability. And the reversal that they've had to do is reverse the 2 things back out. I'm not sure why they would want to do all balance sheet entries. Normally we see people are wanting to push through revenue early. There's no more information in their financials. I've looked there and no more information in the ASIC media release. I guess my key message to you is if you are recognizing weird balance sheet entries from your AASB 15, just have a look and make sure it makes sense. The next one is in relation to a sale and lease back. Now, I know when I've been talking about the leasing standards for a number of years, I hopefully that's the end of sale and lease backs, because there's really no incentive to do them anymore. A sale and lease back initially was to take the asset off the balance sheet and the liability. They come back on if you're leasing back. We've obviously got a scenario here where they've done that. The big challenge for sale and lease backs now is, did you actually sell? Did you actually lose control? Because remember, AASB 15 is all about losing control. In most cases, the answer is no. All you did was switch the transaction. You never actually lost control of the asset. And I'm guessing that's what happened here. And that's why they recognised a gain on disposal. ASIC came in and reversed that because they said you did not lose control of the asset. The next one is impairment. So a huge impairment of goodwills, inventories and other assets. And again, ASIC's standard comment that we generally see with impairment, they have concerns about the reasonableness and supportability of the cash flow forecasts. So just make sure that you can support those figures and they make sense in the current environment. The next one is a reclassification of liabilities from non-current to current. We still see this as an issue. People don't like having the non-current liabilities, but it's actually, current liabilities, it's actually quite hard to classify a liability as non-current in many circumstances. There is a change that's come through from the International Board, but it's really not going to make much difference. So if you are classifying liabilities as current, make sure you've got, non-current, I'll get my currents and my non-currents right. If you're classifying liabilities as non-current, please make sure you have substantial documentation on why that's appropriate. Going through that section within AASB 101, that definition of a current liability. They've also required to restate comparative information in regard to a fair value gain on a liability. That was a liability that was derecognised, was treated incorrectly. It was one of those weird and wonderful financial instruments that they got the accounting wrong in relation to that. So there's a range of different restatements. Often I just say impairment, impairment, impairment. We've got quite a few different ones this time that link back to some of those matters. This won't be the last of them that are coming through in relation to those matters that have been raised. So just keeping an eye on those. This isn't me asking you for your questions, queries and concerns. This is me telling you what my questions, queries and concerns have been over the last few months. So I thought it would be useful to kind of go, where has the big queries been to me? Leases is one of them. In particularly, related party leases, how do we deal with them? Can we ignore them because we don't have a piece of paper that says lease on it? No, you can't, is the short answer. And we've seen some very large balances being booked in regard to those related party leases. The next one is in respect of lease term. In particular, where one entity is subject to a more than insignificant penalty if that lease ends. So I've had a number of queries, in particular around things like aged care facilities, where you've got, if the aged care provider, the lessee, was to move out, there would be a significant cost for them to find another aged care facility. So even though the lease term may only be, say, 10 years, they've got that rolling ability on a month to month, and therefore it's likely that the lease term is actually the useful life of the building, because they would incur more than an insignificant penalty if it was left. So we've seen lease terms that are way longer than anybody was actually expecting. I've seen a number of entities who have completely ignored that and just taken the piece of paper that says 5 years and gone, this is it, this is our lease term, without considering that international interpretation around that. I suspect over the next few years, we will see some significant changes in regard to the lease accounting as people realise that they haven't necessarily got that right. Similar to what we're seeing in revenue, we're starting to see some changes in revenue as people realise they've got that wrong. Business combinations. It kind of dropped off a little bit, the whole reverse acquisitions and shell entities and reverse backdoor listings, whatever you want to call them, seems to have picked back up again. And people are also realizing that they didn't do it right in the past. So I've had a number of queries where an entity has gone, we did this 2 or 3 years ago, and something's come to light that now shows that we might not have done it right. So we're having to see some changes in respect of that. If you are acquiring any business, please be aware the definition of a business has now changed. The standard has been updated. Please, please, please make sure that you are looking at whether it's a reverse acquisition, whether it's under common control. If you are setting up a shell entity, that shell entity probably can't be the acquirer. And therefore, you haven't got a plain vanilla business combination. Interests in investments. I talked from the ASIC queries and said that please make sure you understand the relationship. The reason it's also in here is 2 of those entities that ASIC approached me and asked for advice. And therefore, it's been weird that why we've had so many of these queries. Some of them is just that the disclosures that were included were rubbish, and therefore it was just a red flag. It just doesn't make sense. Others, I do think that, yes, some of the accounting has been wrong in the past. So I really would emphasize to you, if you've got any interest in other investments, please make sure that you understand whether you control it, whether you have significant influence, or whether it is fair value through OCI. It's not as simple as going, we own 50%, we must control. We don't own 50%, we don't. It's really not focused on the numbers, it's focusing on the substance behind those. And any of you who are listening in the not-for-profit space, I'm sure that last one is not a surprise for you. Significant number of queries about which revenue stream, sorry, which accounting standard does my revenue stream fall into. My last comment that I just want to make is a bit of a don't forget. We have spent huge amounts of time over the last few years talking about leases and talking about revenue. And then earlier this year, talking about COVID and going concern. All the other standards have been just squished into this tiny little bit of our brain that we may have just forgotten about. We do still have every other accounting standard. And you'll see in those issues that ASIC have raised, it's some of those other standards that are actually causing the biggest issues and causing the errors. So it's just a reminder to you that we do still have lots of other standards. I know your focus has been elsewhere in the accounting space. This is just our accounting hat. I know that we've got lots of other things going on in our brains, but just a reminder that not to forget that we do have lots of other standards in play as well. My contact details there, but I'm going to hand over to Michelle.
Hello, everyone. So I'm going to spend the next few minutes just giving you a rundown of the recent changes to the Australian financial reporting landscape. And while these changes are recent, they have been a long time coming, and they will probably be of some significance to many entities that currently prepare special purpose financial statements. So just for a bit of background, the Australian Accounting Standards Board, or the AASB, has for over a decade grappled with what it calls the special purpose financial statement problem, or the SPFS problem. And this problem exists because here in Australia, and only in Australia, entities are able to self-assess their reporting requirements when they are required to prepare financial statements in accordance with Australian Accounting Standards, or AAS. So directors have to apply the reporting entity concept contained in SAC 1 and determine whether the entity is or is not a reporting entity. Where the entity is considered not to be a reporting entity, the directors can prepare special purpose and not general purpose financial statements, and they can essentially pick and choose the accounting standards to apply, depending on the needs of a very limited number of users of their financial statements. So fortunately for the AASB, in 2018, the International Accounting Standards Board issued its revised conceptual framework, which applies to all annual reporting periods beginning on or after 1 January 2020. So this revised conceptual framework contains a reporting entity concept that is very different to the Australian reporting entity concept. So the AASB felt it was as good a time as any to address the SPFS problem once and for all. In order for certain entities, such as listed companies, to remain IFRS compliant, the revised conceptual framework had to be adopted here in Australia, but what the AASB has done is adopt it in stages. So the first stage focused on those entities that have public accountability, so your listed entities. And this stage was finalized mid-2019. What I'm going to speak about today is essentially the conclusion of the AASB's second stage of adopting the revised conceptual framework here in Australia. So for-profit companies preparing financial statements under the Corporations Act will be captured. That would include your large proprietary companies, including grandfathered companies, unlisted public companies, small foreign controlled companies, AFS licensees, and small proprietary companies with crowdsourced funding. Also captured would be those private sector entities required by legislation to prepare financial statements in accordance with Australian Accounting Standards, AAS, or accounting standards. That would be, for instance, your higher education providers, as well as certain incorporated associations. And then also captured would be those entities whose constituting documents, like a trust deed or other document, for example, a loan agreement, requires the preparation of financial statements in compliance with Australian accounting standards, but only where that constituting document or other document was created or amended on or after 1 July 2021, which is this standard's effective date. So take note that AASB 2020-2 does not apply to not-for-profit entities and public sector entities. The AASB will look at these two frameworks separately in the future. So for now, these entities can continue to prepare special purpose financial statements as long as it is appropriate to do so. So entities that can that will no longer be able to prepare special purpose financial statements, they will have to prepare some form of general purpose financial statements from 1 July 2021. And so the amendments under AASB 2020-2 work in conjunction with AASB 1060, the new standalone simplified disclosure standard that will replace the existing RDR requirements. In terms of recognition and measurement requirements of Tier 2, nothing changes. So Tier 2 entities have to apply all the recognition and measurement requirements of Australian accounting standards, including consolidation and equity accounting. What will change are the disclosures that Tier 2 entities have to make, and I will talk to these reduced or simplified disclosures shortly. So who does AASB 1060 apply to? Well, all those for-profit private sector entities that are going to be impacted by AASB 2020-2 and will have to migrate from special purpose to general purpose financial statements. So it will affect those entities, and then also those for-profit and not-for-profit entities, both private and public, that currently use Tier 2 RDR to prepare their financial statements. Because from 1 July 2021, RDR is going to be withdrawn and will no longer be maintained. So just to point out to our listeners today, this is not the end of the road for special purpose financial statements completely. Those entities that are not captured by these changes I've just briefly discussed, they will still be able to prepare special purpose financial statements as long as it is appropriate to do so. I just want to take a minute to talk about these entities, those entities that have a non-statutory requirement to prepare financial statements in accordance with Australian accounting standards. So I'm specifically referring to private sector trusts, partnerships, self-managed super funds, joint arrangements. Many constitutions, I think what's important to understand is that going forward, words used in legal documents will be very important to avoid unintended consequences. So many constitutions and other documents currently contain a general requirement to prepare financial statements in accordance with Australian accounting standards, with the intention being that special purpose financial statements will suffice if there are no users dependent on general purpose financial statements for their information needs. What has changed is that in future, references to compliance with Australian accounting standards in constituting or other documents such as a loan agreement that require the preparation of financial statements in accordance with Australian accounting standards, that reference to Australian accounting standards will relate to a very specifically a defined set of accounting requirements. So this means that documents which refer to AAS or Australian accounting standards may require the preparation of general purpose financial statements which comply with all the relevant Australian accounting standards. This will depend on when and how that constituting or other document was created or amended. Now remember that GPFS can either be tier 1, in which case those financial statements have to comply with all the relevant recognition, measurement and disclosure requirements of Australian accounting standards, or the general purpose financial statements can be tier 2, which have to comply with all the recognition and measurement requirements of Australian accounting standards, but then contain simplified disclosures. So the message I leave you with is just be aware of the way that you draft or change your constituting or other documents going forward, specifically those provisions relating to the preparation of financial information, which will determine the financial reporting requirements to apply. The risk here is that a trust deed, for example, that requires preparation of financial statements in accordance with Australian accounting standards could mean that the trust has to prepare general purpose financial statements depending on when that trust deed was created or amended. Even if the trust deed was created before 1 July 2021, which is the effective date of the new standards, if it is amended in any way after 1 July 2021, and that reference to Australian accounting standards, is left in the trust deed, that trust will be required to prepare financial statements or general purpose financial statements under these changes. So the effective date of AASB 2020-2, as I've said, is 1 July 2021. So these, trusts and partnerships do have some time to consider their reporting requirements and amend their constituting or other documents if need be, to make sure that they're not unintentionally caught by the changes. The AASB staff has released a fact sheet that expands on this particular topic. So please do refer to that. And what's useful is that that fact sheet contains examples of wording to use or not use in legal documents, depending on your point of view and your, I guess, the outcome you're trying to achieve. So please do refer to that fact sheet. I think I've included a link to that fact sheet in the last slide in my presentation. All right, let's quickly talk about AASB 1060, which is the new standalone standard that contains all the disclosure requirements for tier 2 general purpose financial statements. So from 1 July 2021, it will replace the current suite of RDR, which, as you know, are indicated by the use of shading in the various accounting standards. So the simplified disclosure standard is principally based on the International Financial Reporting Standard for small and medium-sized entities, with a few adjustments for the Australian context. Entities that prepare tier 2 simplified disclosures, general purpose financial statements, that's quite the mouthful. As I've already said, they will apply all the recognition and measurement requirements of Australian accounting standards, including consolidation and equity accounting, so the same as current RDR. However, in terms of disclosure, simplified disclosure, the simplified disclosure standard has less disclosure requirements compared to RDR. But if you compare the simplified disclosure standard to special purpose financial statements, simplified disclosures has more disclosure requirements. especially in the areas of income taxes, related parties, financial instruments, and revenue. The simplified disclosure standard also contains an option to not present a statement of changes in equity when specific conditions are met, and this would be the only presentation difference compared to Tier 1 general purpose financial statements. The last block on the slide. So while the IFRS for SME standard does not contain a requirement to disclose audit fees and imputation credits, these two have specifically been added for the Australian context. Audit fees, because it was felt that this disclosure would assist in improving auditor independence and accountability, and imputation credits was added because it was felt that this provides useful information to investors about dividends and future earnings potential. All right, so as I've mentioned, both standards will apply for the first time in annual reporting periods beginning on or after 1 July 2021, which is a year later than was initially proposed by the AASB. The deferral of 1 year did come at a bit of a cost though, because while additional transitional relief has been provided, only those that early adopt these standards will be able to access or utilize this additional transitional relief. So as the table on the slide shows, by adopting the standards early, for example, in years ended 30 June 2020 or 30 June 2021, entities can avail themselves of all the extra transitional relief. So there's three that I'm specifically referring to. The first one on the slide there means that entities moving from special purpose to general purpose financial statements for the first time do not have to distinguish between the correction of errors and changes in accounting policies. So where an entity has not applied an accounting standard correctly in the past, this would in normal circumstances be a prior period error that would have to be addressed separately in the financial statements. However, with this relief, this error could be lumped together with the adjustments arising on adoption of the standards, if the entity so chooses. Entities that early adopt will also not have to restate comparatives. So comparatives presented in the year of transition, they would be the numbers that were presented in the most recent set of special purpose financial statements, which may or may not be AAS or Australian Accounting Standard compliant. So if entities choose to make use of that relief, there are specific disclosures that will have to be made in the year of transition in the financial statements. And then finally, early adopters of AASB 1060 will also will not need to present comparative information in the notes, where such information was not presented in the latest set of special purpose financial statements. So just to emphasize that these transitional relief measures are optional. If entities wish to restate, they can do so using AASB 108. For entities that adopt the standards when the standards become mandatory, so in the year ended 30 June 2022 for June reporters, the only transitional relief they will be able to access is the relief offered under AASB 1 and the first one on the slide relating to the correction of errors. So really, the amount of effort involved in migrating from special purpose to general purpose financial statements is going to depend on what your financial statements look like right now. Where you are applying all the recognition and measurement requirements of Australian accounting standards, but are just making the minimum disclosures, that will be an exercise of simply elevating your disclosures to be in line with the requirements of simplified disclosures. There it goes again. My apologies, everyone. Yes, so you will just have to elevate your disclosures to be in line with simplified disclosure standard requirements. Unless you are a group and you have not been consolidating, well then obviously consolidation is going to be your biggest challenge. If you are captured by these changes, I would encourage you to start having a think about your transition journey and whether you should be applying the changes early, especially considering the additional transitional relief that is available to those who early adopt the standards. All right, and then because of the deferral of the standards, the AASB decided that for-profit private sector entities that prepare special purpose financial statements should be required to make disclosures about the extent of their compliance with the R&M requirements of Australian accounting standards. This is still a proposal at this stage. I believe this is being discussed at the AASB's board meeting next week. And if approved, for-profit private sector entities that prepare special purpose financial statements will have to make the following disclosures in their 30 June 2021 and beyond financial statements. So firstly, the reason for preparing special purpose financial statements, the material accounting policies, including details of changes in those policies, whether subsidiaries and investments in associates and joint ventures have been accounted for correctly in accordance with the relevant standards, where a material accounting policy does not comply with the recognition and measurement requirements of Australian accounting standards, an indication of how it does not comply, and lastly, whether or not overall the special purpose financial report complies with the recognition and measurement requirements in Australian accounting standards. So as I said, this is a proposal at this point, and we will see if this gets approved. Lastly, I would like to leave you with a few thoughts regarding large proprietary companies. As you may be aware, last year, the thresholds for determining whether a company is large or small under the Corporations Act were doubled with effect from 1 July 2019. So as I'm sure you're aware, the thresholds to consider are total consolidated revenue for the financial year, total consolidated gross assets as at the end of the financial year, and the total number of employees as at the end of the financial year. And if a company meets any two of these three thresholds, then it is deemed to be large for that year, and it must lodge a financial report, a director's report, and an audit report with ASIC. Now, the explanatory statement that accompanied the regulation change implied that large companies are economically significant, which is one of the criteria in SAC 1 to consider when assessing if an entity is a reporting entity or not. And the AASB implies a similar message in their basis for conclusions that accompanies AASB 2020-2. And then also ASIC Commissioner John Price stated that the doubling of the thresholds meant that directors of large companies preparing special purpose financial statements would probably not be able to do so for years ended 30 June 2020. So all of this has raised questions about the ability of companies that remain large to prepare special purpose financial statements prior to AASB 2020-2 coming into effect. So in other words, for years ended 30 June 2020 and 30 June 2021. The message I leave you with is that where you do not adopt AASB 2020-2 early, the directors and those charged with governance should undertake a process to re-evaluate the reporting entity status, having specific regard to the criteria in SAC 1 and obviously the explanatory statement that accompanied the regulation change, and document this assessment. In any way, your auditors will ask for this documented assessment because they are required to consider whether the financial report, the financial framework being applied is appropriate in the circumstances. So just something to be aware of. All right, and then lastly, just a quick reminder of the new accounting pronouncements on the horizon. With the December reporting season around the corner, the left side of the slide lists the new standards and interpretations that will be applicable for the first time in 31 December 2020 full year and half year reporting periods. There's actually not too much going on, which I'm sure many of you will be very thankful for, considering the massive new standards that we've all had to deal with in recent years. So I'm just going to touch on a few of them. Carmen actually alluded this in her presentation. For business combinations that take place in years on or after 1 January 2020, take note that the definition of a business has been refined and that the standard has been amended to clarify that to be considered a business, the acquired set of activities and assets must include at a minimum an input and a substantive process. And a fair amount of guidance has been added to AASB 3 to assist in the assessment of whether or not a process is in fact substantive. Also, an optional asset concentration test has been added to AASB 3, which effectively provides for a shortcut way of concluding that an acquisition is not a business combination without having to do the detailed assessment required by AASB 3. So going forward, entities should hopefully find it a bit easier to assess whether a transaction is a business combination or an asset acquisition, which they both have very different accounting treatments. So it's important to get this assessment right. And so hopefully it should be easier for entities based on the clarifications and the extensive new guidance that's been added. Another amending standard worth mentioning is AASB 2018-7. The definition of material has been refined to help preparers make judgments about whether information is material for inclusion in financial statements. I do encourage you to refer to the new guidance and improved explanations that have been introduced to AASB 101 through this amending standard. For entities stating compliance with IFRS, so entities preparing Tier 1 financial, there we go again. Sorry about that. So entities preparing Tier 1 financial statements, listed entities, this is for you. The revised conceptual framework, which I've mentioned in my presentation, applies for the first time in annual reporting periods ended 31 December 2020. So the conceptual framework sets out a comprehensive set of principles that underlie financial reporting, and this has been updated. So, for example, the definitions of asset and liability have been slightly updated, and certain concepts such as measurement uncertainty, stewardship, prudence, and substance over form have been clarified. Just to note, the conceptual framework is not an accounting standard, and it does not override or change any of the existing accounting standards, but be aware of the changes if you use the conceptual framework to develop your own accounting policies in cases where no other accounting standard can be applied to a specific event or transaction. Moving to the right side of the screen, of the slide, these are some of the more relevant pronouncements that will kick in later reporting periods. I've addressed the bottom two in the special purpose financial statements update I've just run through. Just take note of AASB 2020-1. Be aware that the requirements for classing a liability as current or non-current contained in AASB 101 have been tweaked a bit. So the amendments do not change current accounting requirements, but rather clarify them to ensure more consistent classification of liabilities by entities. So the amendments clarify that classification essentially comes down to the rights that exist as at year end, and they also that classification is unaffected by management's intentions or expectations. The standard's effective date has been delayed by a year due to the pandemic, so it becomes mandatory for all annual reporting periods beginning on or after 1 January 2023. So that's still a way off, but I do encourage you to work through the amendments to make sure that they are correctly reflected in your accounting. And this is to avoid any unfavorable consequences, such as a breach of loan covenants, for example, due to reclassification of liabilities on adoption of the amendments. All right, and then what I've done is I've included, there have been a number of financial reporting publications that have been issued in the last few months to assist entities in what is proving, has proven to be a very tough time. But considering the information overload that we've all been subject to, it's probably easy to miss them. So what I've done is I've collated some of the ones that I think would be really helpful going to the December reporting season. And I've also included fact sheets that the AASB staff have put together relating to the special purpose financial statement removal project. So please do refer to those if you need to. And that is it from me.
Thank you, Michelle. Thank you, Carmen. That was very insightful and very useful. So it's great to get those updates and just keep us aware of, although things aren't changing as much, we still have to be very alert to everything that's happening. Now, onto our Q&A. The presenters must have all been fantastic because we don't have much in the way of Q&A. We had one question, and Joel, I know you've answered it, but just for the benefit of the whole group, we had one question about the asset changes for tax. Does it include intangible assets? So can you give a response to that for the group, please?
Yeah, so thank you very much, Rebecca, for that question. So yes, because the explanatory memorandum actually refers to the qualifying conditions for intangibles to get into the instant expensing, by implication, yes, you can potentially have an intangible asset qualifying for that. One thing you need to be careful of there is a few rules around licenses and sub-licenses, because there are also a number of rules which apply to disqualify, for example, second-hand assets.
Excellent. Thanks, Joe. We've got no further questions. Just a couple of things I want to discuss before we finish up. The first one is just want to bring attention to the bottom line publication, issue 7. It was issued recently. So that's a publication that Michelle, who just spoke to you, she writes, and it aims to keep you all in the loop with the latest accounting, financial reporting developments, and the potential impact they could have on the business. Michelle, do you want to comment on any key areas regarding the bottom line?
Sure. So from a for-profit perspective, the feature article in this edition, I guess, explores why it is important to pay close attention when assessing whether holding a significant minority of the voting rights in an investee equates to control, and the factors that should be determined considered in making this assessment. Really, the focus should not be on the percentage of voting rights held, but on whether or not an investor has the current ability to direct the relevant activities of the investee unilaterally. A lot of judgment involved, so we take you through the guidance in the standard that needs to be considered if you are dealing with such a scenario. There's also a piece on the merits of transitioning from special purpose to general purpose financial statements early, which ties in quite nicely with what I spoke about earlier. And then we also provide a brief summary of recent AASB activity, including links to AASB staff FAQs that preparers and directors might find quite useful going into the December reporting season.
Excellent. Thank you, Michelle. You should get a copy of the bottom line if you subscribe to it. If you don't, you can get a copy on the website when it's published, and also you can contact your HLB Mann Judd partner, director, manager, your key contact, and we can get you put on the mailing list if you want a copy of that, the bottom line emailed to you as well. All right, so finally, I'd like to thank you all for attending. I hope you found it useful and insightful. I'd really like to thank our panelists again, Joel, Carmen, and Michelle, for their expert presentations. So there'll be a recording of the session, there'll be PowerPoint slides, and a copy of the bottom line report will be sent to you all shortly. Thank you again for joining us today, and we hope to see you again shortly. Thank you.